welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Roaring Kitty, the account behind GameStop's Reddit phenomenon just 3 years ago, is making his first appearance on X since 2021.
Looking at that inflation side, right, where the Fed kind of set up, just a couple weeks ago, where they said we're really squarely in this wait and see, kind of sort of moment, right? That does seem to me suggest that you have, a little bit more asymmetric risk to the upside from a market perspective if we were to get a little bit better than expected, kind of inflation report.
They would like to move towards easing, but the problem is when you've got core services running at 4.8%, and again, as you highlighted earlier, that just the traditional core rate, ex food and energy, is running at around 3.6, 3.7%. It's very hard for them to start signaling that they're ready to ease.
We've got 1 hour to go until the market close, so we're taking a look at the major averages sponsored by Tasty Trade, and then Jared's going to help us walk through some fireworks that are happening in today's session. But first, let's look at the major averages here. We've got the Dow down about 62, 63 points today. That's a drop of about a fifth of 1%. The S&P 500 almost exactly unchanged right now as we look at it, and the Nasdaq moving up by about 0.25%. Why are we not seeing more action? Well, investors are looking to inflation data that we get later in the week, both producer prices tomorrow and then followed by consumer prices the day after for more direction on a macro basis here. That's also reflected in what we're seeing in yields today. Also not seeing much change. They're hovering just under 4.5%. Also, we're watching what's going on in the crude oil market there, a gain of a little more than 1%. We're going to get some more details on that oil trade later in the show. But in the meantime, we got to get to Jared because he is taking a look at what is going on with the meme stocks today. Yep, it is not 2021, Jared.
I woke up this morning. I didn't expect this gift, but we have been treated. Oh, guess what? Roaring Kitty is back. The volatility is back. The volatility pauses are back as well. So here are our meme stocks today, and let me sort by performance because we got some eye-watering numbers. I know it's, really small, but AMC in the upper left, that is up 83%. GameStop up 76%. Tupperware, remember that? That's up 40%. Cost, just a little bit less than that. Newegg, and I could go through the names: Beyond Meat, Virgin Galactic, and the list goes on here. I haven't seen a lot of these names pick up in a while, but I would say over the last couple weeks, some of these have been showing strength. And in fact, I was writing about this in the morning brief. Specifically, I was looking at clusters. Now, this chart goes all the way back to 2021, the beginning of the meme stock craze. Anytime you see an orange dot, that's when you have a cluster of meme stock volatility outbreaks. And what we saw in 2021, this happened at various intervals, not really predictive as to the general market. But then when we got into 2022, anytime you got a cluster, they were laggards. Money was rushing into the laggards. It was a good time to sell the general market. But this latest lag up since October, I've seen meme stocks kind of interspersed randomly or maybe somewhat evenly. I don't see the predictive power there. And what I said a couple of weeks ago is that meme stocks is probably just another example of risk on. And that may be what we're seeing today. So a couple of, or actually more than two, Roaring Kitty videos later, here is where we are. Let me just show you a stock of GameStop. This is intraday, and what it did here, this is about 120, 130% up at the highs, and much like I saw in January of 2021, you would see this kind of settling down. You'd find the market come to an equilibrium before launching off again. So going to be really interesting to follow this trade all week, guys.
Thank you, Jared. With the meme stock frenzy back in the spotlight, let's bring in Yahoo Finance's Miles Udlern here for more. So Miles, Keith Gill, Roaring Kitty.
Thank
he posts on X.
his proper name.
For the for the first time in a long time, right? GameStop rips. What do you make of it?
This is, can I just say?
Yeah.
This is Miles' favorite subject, and that's why I wanted Miles to come. I don't know about
Look
favorite.
at that smoke. Oh my God.
But it's
Is
up
that
there.
true, Miles?
Well,
It's-
Miles and I lived through the first meme craze together, and I saw how much joy it brought him to talk about this stuff.
I think
Does it still bring him joy?
I think the reason that I remain so drawn to business media is that it's much more fun than most other media things that you can cover. It's just not that serious. Like, there's a lot of money at stake.
And yet people, though, they try to assign seriousness to something.
Well,
like
I mean, there is some seriousness when it's, trillions of dollars and all this, and it's people's retirement, et cetera, et cetera. But the vast majority of that is spoken for in, conservative, time-tested strategies with all, like, an incredible amount of regulatory, apparatus around that. But there are these things that exist within markets. The entire crypto market is basically this. Meme stocks are the equities version of it, where, it doesn't make, it actually makes complete sense. I think people over-intellectualize something that's pretty simple, which is that there's now huge amount of people aggregating their conversation on the internet, mostly on Reddit. In this specific case, it can be other places. It could be the Yahoo Finance message boards. It could be YouTube comment section, et cetera, et cetera. And there is a very clear momentum when a certain person, in this case Keith Gill, also known as Roaring Kitty, speaks about a certain stock, in this case GameStop. There's an impulse to buy it because of what has happened in the past, and because pretty much everyone who's involved with this knows it's a joke, but it's also up 80% today. So, go for it.
There you go.
It's just money.
And just to be clear here, all of this was set off by a tweet that he tweeted. He hasn't tweeted since June of 2021.
It's a great
that
tweet.
is a picture, presumably of him or of someone, in a gaming chair, leaning forward.
Locking in.
Leaning forward. After sitting back for a couple years, he's now leaning back forward. And then that tweet, by the way, was followed by a bunch of mashup movie meme kind of tweets throughout the course of the day.
One of them had the theme of run. So, run. I took it to be like run stock. The stock's going to keep running, or it's been on a run and it will continue running. Also, let's not forget, Keith jumped onto the scene with a series of extremely earnest and detailed fundamental breakdowns of GameStop's business in the summer of 2020, when literally no one was paying attention to it. It was I don't even know split adjusted what it was at this point. It was a single-digit dollar stock, and he's like, it's definitely worth way more than that. And who knows what he's done with his portfolio, right? The cynics in us could say he went out and bought a ton of short-dated calls this morning, and then he sold them all, and he's made all his money and jokes on everybody else. But he was a true believer way before there was any meme. He literally just liked the stock, as he put into the official record when he testified before Congress.
So your point being, Miles, maybe just see this as what it is to a lot of people, which is fun, which is entertainment, which is Dave Portnoy now jumping in. He's posting about it. Portnoy will be the first one to tell you, I'm not an investor, I'm a gambler.
Yeah, and I think also, as Jared was outlining for us, there has been this energy within the market of pockets of enthusiasm, pockets of risk on. I think the more serious versions of it is, look at what we've seen with Chinese internet stocks over the last month. They have ripped higher. Look at what's happened with utilities over the last month. They have ripped higher. There's a lot of energy in markets right now, coming back to a more serious tone, for people seeing Mag 7 goes up. That group has divided away, but there's this sense of, if rates are going to go lower over the next year or whatever, equities are probably going to be a beneficiary of that. What isn't played out? And we've seen that money move around, and maybe you could make the argument that if the meme stocks have been dormant for some time, maybe that's not played out. AMC ultimately was the more meming meme stock than GameStop, right? And that stock's up more today, which I think tracks. AMC is the real plaything. GameStop has a more real business, I would say, than AMC does.
Yeah, well, speaking real business, I was looking at the numbers for GameStop in terms of what's happened to its sales over the past few years. Last year, its net sales were about $5.3 billion. Its net income was $6.7 million. But if you look at the chart of the trajectory for either its sales or its income over the last few years, it's been down and to the right. It has not been a good trajectory. But, how much of this is just, it's fun. If people are having
Absolutely.
fun.
I think fun.
This.
I think GameStop is more fun because if you look at what the management at AMC has done over the last 2 years, it's actually not that fun. They've like explicitly bilked all the shareholders who piled into the thing. They got this weird, the ape share structure that got folded back at AMC. Everybody loses a ton of money. The CEO gets paid a ton of money. He says, "Don't worry, I'm not actually having the money," but like he does because he unloads all the stock. That's not really that fun. That's a very cynical and dark story, I think, within markets. I think GameStop, while Ryan Cohen has his issues and he doesn't talk to anybody, it's management's prerogative not to host an earnings call that's open to analysts. And a lot of analysts, kind of stopped covering these companies too, especially GameStop, right? They gave up on it. So I wouldn't say, GameStop's all like, roses and sunshine, but it doesn't quite, to me, have some of the, I don't know, like the slickness that has gone on at AMC.
Oh, interesting.
I mean, I'm not the only person saying this. No. Like, this is a broad take. I think if you look at the machinations that have happened at that company.
Well, Miles Udland, I'm glad to see the gleam in your eye when we discuss these issues. Hey, thank Keith Gill, right?
The other thing is, this will be over tomorrow probably.
Wait,
it'll be, let's hold this preview CPI, and then we'll react to CPI, and then we'll discuss, next week's Nvidia earnings. That's why the meme stock trade is so fun, because it is an actually fun thing in a day in, day out kind of grind through stocks that can feel a little grindy.
Yeah, it can. Well, this is a little ray of sunshine. Thanks so much, Miles.
Outside.
Appreciate it. All right, roaring kitty, as we've been talking about bringing the meme trade back to Wall Street and beyond. A single post on X sparking a massive rally in GameStop shares, with volume hitting its highest level since 2021. It's not just GameStop, as we've been discussing. Shares of AMC, Tupperware, remember that's a meme stock, BlackBerry, they're all moving sharply higher. Joining us now, Tasty Live founder and CEO Tom Sosnoff to talk more about this. Tom, thanks for being here. Are you having fun today too? You heard us just talking about it. What kind of activity and chatter are you seeing today?
It's kind of, of course I'm having fun, but it's all the chatter we're hearing today. I mean, there really isn't much else. So it's been a slow week. Last week was pretty slow. So this week, everybody came in all perked up, and it's kind of dominating the story time.
Do you see, Tom, is this kind of a broader sign of just risk appetite ramping right now to you? And if so, do you see that kind of playing out in different data points? Do you see that in the options market?
Well, for sure. I think that there was a real lack of new ideas. There was a real lack of there was a lot of complacency in the markets. And like I said, the last 2 weeks were kind of slow, and this rally has been kind of a grind to the upside, and vol's been crashing. So I think that, this move today was really welcomed especially by option traders, but also by kind of everybody, just as another level of excitement. I don't look at this at all like I did in 2021, when it was almost a transformational moment, dragging, tens of millions of people back into the marketplace. That's not what we're seeing today. This is just, this is all the players just kind of transitioning or moving into something that's actually active. This is kind of like the old days on the trading floor when there was a lot of noise in one pit. Everybody would run to that pit. That's what we're seeing today.
Well, Tom, there was another aspect of this whole phenomenon in 2021, which was like the narrative of the little guys trying to stick it to the big guy, right? Trying to stick it to hedge funds. And of course, we know Gabe Plotkin got caught up in that, and there was a big short squeeze. What's fascinating to me today is that there's still a short squeeze. The 24% of the company's float was still shorted going into today. According to S3 Partners, we're looking at $936 million in mark-to-market losses as of earlier today in a single day. It's so interesting to me that there were still that many people shorting this stock kind of quietly in the background.
I don't know. Well, first of all, the float is a lot. The float's a lot bigger than it was, 3 years ago. And so that is there's been a couple of splits. There's been, a lot of stock that's been issued. So it's a very different situation. And you also have to remember that those numbers are really misleading, because there are huge index fund positions right now. And on the short side of the index funds, because interest rates have been popping up, there's a lot of short stock out there that is just tied into different index arbitrage positions. And, GameStop's one of the bigger, Russell 2000 stocks. And so you're really talking about a lot of that number is mixed in with just, huge ARB positions, and they don't really necessarily, they're not going after GameStop, for example. They're just shorting the index because it's an ARB play.
And Tom, who's in GameStop right now? Is that retail, institution, both?
Well, I would have to think that there's some institutional and some prop speculators, but I also think today you're seeing, so what happens when you have a move like what you're seeing today is that a lot of the high frequency firms, after they learn their lesson in 2021, they try to get ahead of it. So a lot of the volume is high frequency firms and market making firms that know that there's going to be customers coming in on the buy side. So they're just trying to get in front of it so that they have some inventory to lay out. So I think that's part of it. And that's part of the excitement. That's part of the huge volume. But I would say that this is a lot more retail. And a lot, when we say retail now, it's kind of a mix, but retail is very customer. And I would say that today there's been a lot of customer interest, especially like just in our own office. I'm seeing it. People are talking, and a lot of people that just work here. They're buying, they're buying some GameStop. They're buying some AMC. They're just toying around with them. It's mostly just kind of, it feels like play money, but I feel like we're seeing more of that than we've seen in a long time.
And what do you think is driving that, Tom?
Oh, it's just, like I said before, it's just there's the markets for traders. And I come from, this has been my world for a long time in the trading world. Traders are just attracted to noise. And what's happening today is that there's an incredible amount of noise after being almost, you could hear a pin drop for the last couple of weeks. Today, all of a sudden, there's this, incredible amount of noise. It's like a stadium that erupts and you want to know who hit the home run. Well, that's kind of what you're seeing today. And it's just a lot of noise and everybody's attracted to the noise. So all of a sudden, you got to get involved. I think it's good. It's good for the industry. It's good for business. It's good for what we do. It's good for what you do. And it's kind of good for everybody in a fun way. I don't know how sustainable it is.
Well, that's what I was going to ask you, Tom, on this thing. Do you expect what we're seeing here in GameStop to continue, or no, you'd expect it to fizzle out pretty fast?
Well, as a hardcore contrarian, I do not think you are going to see, this is not going to be a repeat of 2021 and that whole, that crazy meme stock explosion where GameStop went from, $15 to 500 and back down to, whatever, 100 or something. I don't think you're going to see that. I think this is going to be a much more muted version of what we saw, and maybe 2 or 3 days. But I don't think there's much more than that. I do not think this is 2021 all over again, but I do think there is an incredible amount of speculative capital out there that is just kind of begging for a shot, begging for, just kind of, I don't want to call a lottery ticket, but I do think there's a lot of speculative capital out there that's just looking for a play.
And Tom, finally, just quickly, do you think that regulators are going to be looking at Keith Gill again, with that tweet kind of setting off this huge explosion?
I really don't. I mean, I know it kind of, no, I just don't think so. I think that, fool me once, I get it, but I don't think that's the same thing now. I don't think this is, at the current levels we're at right now, Julie, I don't think there's any chance there's any regulatory issues at all. I think this is pretty clean fun at this point. I just don't see it beyond that. I don't think it gets to anywhere close to where it was in 2021 when there was, industry-wide issues and Robinhood had those problems, clearing issues and things like that. I do not see that happening at all this time around. There's very different margins. There's very different, the float on the short stock side. All the stocks are hard to borrow. It's not that easy.
All right, I like to hear that. Pretty clean fun. Thanks so much, Tom. Great to catch up with you on this.
Thanks, guys.
We're just getting started here on Market Domination. Coming up, Apple is putting all its chips on the table, announcing a partnership with OpenAI. We'll break down what that means for the iPhone maker on the other side. Plus, the latest episode of Yahoo Finance's video series Next, a glimpse at the future of neurotechnology. That's in the 4 p.m. hour. And it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into 2 stocks to help you make the best choices for your portfolio. Stay tuned, more Market Domination after this.
OpenAI wrapping up a live stream conference earlier with Chief Technology Officer Mira Murati unveiling a flagship chatbot model called ChatGPT 4o. Let's take a look.
Okay, so ChatGPT, this is what I ended up with. How does this look?
It looks perfect. You've solved it, and x equals 1. Nicely done. How do you feel about solving linear equations now?
Yeah, honestly, I'm now pretty confident I can solve linear equations.
Joining us now is Patrick Moorhead, founder, CEO, and chief analyst at More Insights and Strategy. Patrick, it's great to have you on set.
Josh, it's great to be here. Usually I'm in front of a computer screen, but here we are in the big studio.
You were in New York, and we had to make it happen. So let's get right to the news, Patrick. So OpenAI announces this new flagship model. They say smarter, faster.
Right.
First, just give us your response to the news, what you heard today, Patrick, and how you think it impacts kind of the broader kind of competitive environment we find ourselves in.
Yeah, so first off, timing is everything. So tomorrow's Google's big Google I/O conference. They're the king of search. They're the kings of advertising. And this was clearly timed to give Google advertisers something to think about. Obviously, we have Apple WWDC in a few weeks. And yes, it impacts them because they want to get out and define what the quote unquote best intelligent agent or assistant experience is, and this brings together voice, it brings together images and videos and text in a very interesting and human-like interaction mode.
Yep.
So what I continue to struggle with, and I don't know if this changes the paradigm. Okay, so ChatGPT comes out late 22, early last year, explodes in interest. All of these grand predictions about how it's going to change the world. You and I are still sitting here in person. My life hasn't changed at all as a result of this. I know some people who use it as a tool, fine. In corporate America, they're integrating it to some degree, but it's still kind of unclear. Like, where's the big deal? Where's the thing that's going to be this revolution that seems to have been promised?
Yeah, so technology is always slower to be adopted than we all think it's going to. In Silicon Valley, right, it comes overnight, but the reality is to hit typical consumers and even businesses come years after use. But you have to show off the latest and greatest to get people excited. It's kind of like the beginning of an investment bubble, right? Let's get everybody excited. Let's show the capability. We're going to hit the trough of disillusionment at some point, but it's to get people tied in. Now, when it comes to software and services we can use on our smartphones, like ChatGPT 4o, it is a much faster time to use than, let's say, building a new product like the rabbit that you stick on your lapel that unfortunately bombed early. But I think it's a good testament to what we should expect to see from a Google, an Apple, and even a Microsoft.
Do you think, Patrick, though, for big tech investors who are listening right now, how concerned should they be that users start using OpenAI's ChatGPT more and more and relying less and less on big tech voice assistants?
So it is a risk. I don't think it's a midterm risk, but if Apple and Google don't get in there and plug the hole, or potentially, for Apple's case, align with OpenAI, it could spell trouble, because if you look at the biggest applications that just took the world by storm, like Facebook, it was initially free. Google Search was free with no ads, right? So you weren't paying for it. And this has the same type of risk. If you get eyeballs and experiences coming in, you could, OpenAI could monetize that multiple ways through a service payment, through advertising, through essentially sending you to another chatbot for a company that does make money, a food services company, an airlines. That's how it could be monetized. And that is a potential risk to both Google and Apple.
And speaking about Apple, there was also a report that Apple is indeed going to be partnering with OpenAI for some version maybe of its chatbot or on the upcoming phone cycle. Do you think that is going to happen? Do you believe that is going to happen? And then what are the implications, not just for Apple, but for Google in that case?
Yeah, so I put the odds at about 50-50 that we'll see the two come together. There could have been some of the leaks that saw the Mac OS desktop app that was announced today, and they took that to the next level. But Apple does need help in certain areas. And there's two types of AI. There's on-device AI, which would be on the iPhone and the iPad and the Mac, and then there'd be the cloud-based services. I believe if there's going to be any deal, it would be cloud-based services, maybe a type of deal where Google pays Apple today $20 to $30 billion to get Google search as the default search on the iPhone. Maybe this is a deal like this, or maybe it's less of a payment, but more of a quid pro quo. Apple has to have very good on-device AI, or literally it's going to spell trouble for Apple, because that's what it does. It's all about on-device. It's not about the cloud. Apple's biggest level of sophistication on the cloud is backups and streaming media and video, which in aggregate aren't that complex. And if you recall back, things like Mobile Me were just complete disasters. I do believe that we will see a Siri relaunch at WWDC, and it will incorporate generative AI, potentially some help from OpenAI. And again, it's not just one model. You're looking at probably 40 models that have to be addressed in between what's on the device and at the cloud to do different types of things.
And you hit on a point, which I want to touch on, Patrick, because let's say Apple and OpenAI get this deal done. Tim Cook and Sam Altman, they work it out, the lawyers, they sign the paperwork. Your point is you think it's possible that Sam Altman pays Cook's company because Altman thinks, you know what, yes, I'll pay to get in front of these billion-plus iPhones.
Yeah, this could be the long-term play for them, right? Yeah. Let's get people hooked on OpenAI and ChatGPT, and that would pay dividends for years. In a very similar way, I mean, OpenAI is losing a tremendous amount of money today, a lot of money, and they can either invest it into infrastructure, advertising, product, or a potential deal to get on the most pervasive brand out there, which is Apple.
Finally, I'll get you out of here on this, Patrick, a different headline. Reports that ARM is going to develop AI chips. The key word being chips there.
Yes.
No one knows ARM better than you. How much credibility do you give that report, or you think it's bogus?
So creating actual products, meaning you buy a chip from them, I put very, very low probability. What I do put a high probability against is them getting into them licensing the intellectual property like they do to Apple, like they do to Qualcomm, like they do to AWS and Azure, which enable other people to use their intellectual property to build AI accelerators for phones, for tablets, for PCs, and even in the data center. I do think that will happen, and quite frankly, I think that's might be priced into the stock already when you look at the multiples that it's trading at right now. Investors want to see more tangible AI goodness, even though they're the processor behind it. And a lot of AI is done on a CPU. They want to see specific AI IP.
Patrick, we didn't plan it this way, but you were the perfect guy to have today on set.
Maybe we did plan it. I don't know.
Thank you for coming, my friend.
Thanks for having me on, Julie.
Thanks,
Josh.
Moving on, time to check in on some of today's top trending tickers. Shares of Walgreens Boots. Let's start there. Lions higher today on the back of a report. The pharmacy giant was looking to sell its arm of drugstores in the UK. This according to Bloomberg. So this was an interesting one. So the news, and again, this is per Bloomberg, Julie, citing sources. They're kind of reaching out. It sounds like to kind of gauge interest in the drugstore chain. Early stage discussions, apparently. Possible bidders, we're not sure. No formal sales process yet. But the chain could be valued if it goes through at around $9 billion in an exit, which explains investor reaction.
Yeah, I mean, what's interesting here is it was just about a decade ago that they became Walgreens Boots because they bought the thing in the first place, and it was sort of a series of different transactions and stages that led to the deal going on. But Walgreens has had a really lousy year. The shares are down sharply here. It hasn't been growing, cut its dividend. And so, you know, it looks like it might be coming from a place of weakness, certainly, rather than strength, as it tries to figure out whether this would make sense.
Yeah, I mean, to your point, it's been under a ton of pressure. Let's pull up a chart there, and the stock's been hammered. with the capital returners you mentioned, lowered the profit outlook, talking about consumer spending, not great on non-essentials, they said. So investors maybe getting some relief from that headline.
Yeah, and then there is another potential deal that we got to talk about. Shares of Kraft Heinz, are watching those as well today. That's after a report the company is looking to sell its iconic Oscar Mayer brand. That's according to the Wall Street Journal, which says that Oscar Mayer could go for between $3 billion and $5 billion in the sale. It's interesting, the shares are not moving much, and I don't know if that means that investors are not taking this terribly seriously, or they don't think it's that likely to happen. Kraft Heinz shares down a little more than 1% this year. There is a new CEO of Kraft Heinz, Carlos Abrams Rivera, who has been sort of looking through the portfolio and trying to figure out what makes sense.
Yeah, you could strategically, you could understand it, because we know the company's kind of been moving with the times, or trying to. Consumers are more interested in health and nutrition, more concerned, we know, about sugar and sodium, so they're making moves there. And so you understand in a broader strategic sense how it could make sense, but it doesn't sound like we know right now who might be curious. Is it a PE firm or some food industry giant?
Yeah, maybe that's another reason why it's not moving that much. It's sort of very open-ended and vague about what the outcome of this could be.
We await specifics.
Yes, we do.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. Stay tuned. More market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're parsing through the banking sector, and joining me here to discuss is Jay Hatfield, Infrastructure Capital Advisors CEO. Jay, come on down here so we can get to the stock that you like first. Let's start there. And it's Goldman Sachs. So Goldman Sachs, interestingly, has already had a pretty good run over the past year. You can see the stock has moved higher again after its most recent earnings. So let's get to why you still like it here. First of all, you say it's still trading at a relatively attractive multiple.
Yes, in fact, we're actually carrying estimates 10% above consensus. So it's 11 times consensus, and we're at 10 times. And the main reason that we're above consensus is that we're more optimistic about investment banking. And really, Goldman is the pure investment bank of all the investment banks. And I think most people don't appreciate, I used to work at an investment bank, and they don't appreciate the synergies between investment banking and capital markets. So when you do deals, then that generates extra trading for the trading operation. And you saw that in the first quarter, where really the whole firm just outperformed.
Yeah, and let's dig into that a little bit more, because we're seeing that. We're seeing fixed income underwriting. We're seeing also that sort of capital markets are perking up a little bit in some areas. There's a little more M&A coming out. There are a little more initial public offerings. So you think that's going to be good for Goldman?
We do, and even in 25, you just had an great AI segment. We think that the AI IPO boom will start in 25, which it normally does, because and that's why the U.S. capital markets are so efficient, is that we, high valuations of the public companies generate IPOs. So we think it's a little bit of a longer term play. That's why, even though the stock is working now, we don't think it's overvalued, and even will get better as we go through the summer, have rate cuts, at least from the ECB, and then have a rally in 25.
Right, and I think our last one was that derivative AI play. There's also the fact that they exited the consumer business, and so now they're even a more, they were a pure play, then they got into the consumer business, it didn't go so hot, and then they got out of it. So they're back to being more
right, and I think that's
play.
why the multiple's lower, like Morgan Stanley trades at 13 times. They were more resilient during the downturn because they have more steady wealth management. Goldman's is about 80% banking, investment banking, and Morgan Stanley's 40. So we think it's time to kind of rotate from the safer. I mean, we wouldn't be out of Morgan Stanley, but we're short it, certainly, but going to trade pretty well together. But you get more leverage to banking from Goldman Sachs.
Gotcha. A little more oomph. We always like to talk about what the risk is in this situation. And in this case, it's, if markets don't do as well, then they could be a victim of that, because they don't have that insulation, right?
This is absolutely a bull market play. I remember when I started on Wall Street at Morgan Stanley, during a down cycle in '89, we were trading at 0.4 times book. I mean, it used to be these investment banks just got smashed. So they're high beta stocks, 1.2 beta, very correlated in the market. If we're bullish on the market, we have a 57.50 target. But if we're wrong about that, you don't want to be in financials, and certainly not in investment banks.
Gotcha. And you guys have a pretty decent position in
This is our largest position in ICAP, so we're pretty bullish about it. But it's a sector we know. We're in Manhattan. I worked in investment banking. Understand that when things start going, this is just the beginning, in our opinion, of the boom.
All right, let's get to an area you don't necessarily want to be, and that's more in the regional banks. And here we're showing PNC Financial as just one example of the regionals, which largely have underperformed some of the larger financials over the past year. So there you're looking, they don't have the benefit of being as much in the capital markets
They're
business.
5%. I mean, to pick on PNC, they're just 5% capital markets.
Gotcha. So that compares with Goldman, that's almost
80,
all of it. Right, exactly. So one reason there that they're not going to benefit. Net interest margins have been under pressure. And talk to us about how that's working for the regionals relative to rates as well.
Right. So PNC is forecasting themselves about a 5% decline in net interest margin. And the problem is when rates go up really fast, the deposit betas, they call it, or the sensitivity to interest rates start hitting, which is just a complicated way of saying people realize they can get 5%, so they're not going to leave money in a checking account or a 6-month CD. So they've seen those outflows, which means their net interest margin's pressured. And also they have slow loan growth too, as well. They're probably being conservative about putting credit out right now. So those two things are putting pressure. It might get better in 25, but you have something that's declining with regionals and something that's booming with the investment bank focused. And also they tend to have less exposure to net interest margin as well.
And the other thing, we've all been trying to sort of read the tea leaves on the consumer from the payment companies, buy now, pay later, from the regional banks themselves, from retailers. And it does feel like they're starting to see some deterioration on the lower end, at least.
Definitely. I mean, if you just think about it, it's sort of, there's a have and have-nots in the U.S. consumer. Anybody who owns a home did really well from the inflation, and anybody who doesn't did really poorly because they had to pay really high rents that are flat now but not going down. So if your wages didn't keep up, so there's definitely pressure on the lower income consumer. Unclear how that's going to unfold, but if you look at the more investment bank oriented, they have, particularly Goldman's now getting out of it, they have less exposure to that. These large banks, their credit exposure is hard to track. They're not like REITs where you can model every building, so we don't really know what's going on there, but it's a potential downside.
And could we see defaults, for example, that would affect
They're rising slowly already. We don't think they're going to be terrible, but if the Fed didn't cut rates, we might have a slowing economy, recession, so it's just further risk without the upside of investment bank.
And so conversely, we'd like to talk about what could go right for the regionals, and it's what you kind of just referred to, that the Fed could cut and maybe cut a little more aggressively than expected.
Right, if the yield curve de-inverts and we're well into 25, so it's a longer term story, the banks are going to do fine. And by the way, if there's a bull market, they're going to go up their risky cyclical stocks. So it's probably could be a situation where in 25, maybe investment banking is kind of already at full force, and then it's time to rotate into and benefit from the net interest margin slowly getting better in 25.
And as for the regionals, do you have any position there? Are you sort of underweight?
We're intentionally completely out of regionals, and not just in the investment banks, but in the money center banks. They tend to be better hedged, less dependent on net interest margin, have more capital markets upside. So they're just better positioned, in our opinion, in this market.
Okay, so let's summarize what you're telling folks, Jay, here. You're saying you would recommend buying Goldman Sachs, given that reasonable trading multiple, potential benefits from avenues like fixed income underwriting, other capital markets, and AI-related IPOs coming down the pike. And you say, avoid regional banks. There's limited upside from capital markets. They're not as exposed. There's possible pressures on profitability from rate cuts and potential for credit metrics to worsen. Thanks so much for being here, Jay.
Thanks, Julie.
Good to see you. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
Oil edging higher on improving demand from China, and the market is waiting on CPI data on Wednesday. Yahoo Finance's Inez Ferre here with the latest. Inez.
Yeah, Josh, and we did see today WTI up about 1%. We also saw Brent crude higher. Now, WTI has been trading within a tight range since around May 2nd. So it did settle above $79 per barrel. Brent crude on our Wi-Fi Interactive settled above $83 per barrel. And we have been seeing oil off of its peak from April. And that's basically because of the unwinding of the geopolitical risk in the Middle East. But nonetheless, a lot of analysts are saying that, look, Brent crude, it's up 10% year to date, around 10%. And you are going to see Brent ceiling at around $90 per barrel. They do not think that Brent is going to go past 90. OPEC Plus doesn't want it to go that high because then you will see a recession worldwide. So OPEC Plus also, by the way, analysts are expecting the oil alliance to extend its production cuts beyond June.
And Inez, sticking with the oil space, but getting company specific here, there are some new developments in the Chevron-Hess deal. And some big, if not opposition, at least, I don't know, maybe a fly in the ointment here.
Yeah, that's right. This is from a proxy advisor, and proxy advisors are hired by big shareholders like mutual funds, like pension funds, to advise them on merger, on what they should do, how they should vote in merger deals. And this one is with respect to the Chevron and Hess deal. So Hess shareholders are being told by this proxy advisor that they should abstain from voting on that acquisition of Hess at the end of May. Basically, with this proxy advisor saying that this entails, that the deal entails risk that it may break down, and then there would be no compensation in the end for shareholders. Now, I did reach out to Chevron. Chevron said that they look forward to this Hess shareholders voting on this deal. But look, this all comes down to the Guyana stake, the Guyana operation of Hess. This is why Chevron wants to buy Hess, and ExxonMobil has taken the companies to arbitration, basically saying that ExxonMobil has a right of first refusal for that block. ExxonMobil has about a 45% stake in that block and says that it has a right of first refusal for that block. So wait to be seen what happens with this deal.
All right, Inez, thank you so much. Appreciate the update.
Yep.
Coming up, stick around. More market domination still to come. Stocks are mixed just ahead of the closing bell on Wall Street as investors await now key inflation data on Wednesday. For more on what to expect from that April CPI print, we want to welcome in Jim Schmigel, CEI-CIO. Jim, it is good to see you. So markets, look at the major averages, kind of modest moves today, Jim, but we do have that big inflation print on Wednesday. CPI is on deck. What do you expect to see there, Jim, and how important is that for the market?
Good to see you, Josh. Thanks for having me. I'll start with the latter question first. It's very, very important for the market. All eyes definitely focused on this number. We had 3 hot prints in a row, as most investors are aware, and the Fed is really running out of room here in order to deliver the cuts that I think most investors would love to see and that the FOMC wants to deliver themselves. So one data point doesn't make a trend. So they're going to need a few more after this one, even if this one does come in light. I will say the whisper that we are hearing around Wednesday's numbers that we should expect slightly weaker. But even if we do get something slightly weaker, you're still looking at a 3 handle on probably both headline and core, still leaving the Fed in a pretty tight spot if they would like to see rate cuts coming in calendar year 2024.
So, Jim, how you then sort of position yourself going into that? Do we just assume that rates are going to stay where they are for a little bit here and sort of strategize, accordingly?
We're actually taking a little bit of a more pessimistic stance as it comes to rates. We are a little bearish. We do expect 10-year in particular to try to maybe retest that 5% level that we saw about a year or so ago. And even at the very least, get that 20 or so basis points back post the last FOMC press conference, where really what Chairman Powell went ahead and did is took any talk of a rate hike completely off the table. So, with the trend that we've seen recently, a bit of a reacceleration in inflation, the market began pricing in the probability, however small, of a potential rate hike coming in here. Powell went ahead and squashed that, and we had the 10-year kind of rallying below 450. So, from a positioning perspective, we're taking, relatively modest moves at the margin, but our view is for rates actually higher between now and the end of the year.
Jim, we talked about that CPI print this week, but another date on the calendar for investors is Nvidia. Their earnings are coming up as well. Could that be a catalyst for the market, Jim?
I think it absolutely could be. Look, if you take a look back the last 12 months, maybe even 18 months, Nvidia is in one way kind of all that's really mattered. I mean, as much as we talk about the Magnificent Seven and whether that's turned into the Fab Four now or the Terrific Three, who's ever left standing, Nvidia is clearly the juggernaut of the bunch. So you're trading at 40, 50 times kind of forward earnings. When we look at that as a possible event, we're looking at that relative to the VIX. So equity volatility, we think, has been unusually low given everything else that's kind of happening in the world. And just given the overall importance of this one individual name, the earnings, the percentage of investment, the percentage of earnings that this one name, the percentage of performance, I should say, year to date that this one name has delivered, not just year to date, but also in 2023. A lot of importance riding on this one number.
Jim, talk to us about utilities a little bit, because that's an area that has been rallying. I believe you like it as well. Why, and this is not typically a group that does well when rates are high. Do you think it's going to be able to continue to run here?
Yeah, we're a little skeptical on that. So we're kind of neutral utilities. I think it's a great point, Julie, because this hook in the utility performance, if you track the chart on Yahoo Finance, you can see that it's been pretty recent rally there. And I think a lot of that has to do with this kind of dovish stance that the FOMC came out with. So everybody knows we started the year with these huge expectations, 6 rate cuts kind of priced in, or investors trying to bake in the cake for 2024. That's been walked all the way back. And now we put a few more back on thanks to the dovishness from the last press conference. And I think utility is always a bit of an income play. Whenever there's expectations for lower rates, you would expect utilities to kind of hang in there. And that's what we've seen recently, especially with that kind of strong performance post press conference.
So, Jim, you said you're a bit skeptical of utilities. Where do you see opportunity right now, Jim? What sectors look attractive?
Yeah, it all kind of goes back to the same point, which is kind of our view for rates. We think rates head higher. We think inflation is going to be stickier for longer. And if we have that view, that's going to probably, not too surprisingly, lead us into the direction of more kind of value type names. And what represents kind of good value right now? It is financials. Good conversation in the last segment on financials. Very, very diverse part of the market for sure. Investment banks, money center banks look pretty attractive right now. Forward earnings in 12s and 13s and 14s relative to the broader market at 22. We're also looking at things like materials and energy. So things that really aren't overly geared to an interest rate kind of move, or at the very least are going to benefit if we do see rates kind of drift higher from where they are today.
Jim, thanks so much for joining the show today. Appreciate your time.
Thank you.
Well, wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
There's the closing bell on Wall Street. Now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session, sponsored by Tasty Trade. So let's see where the major averages ended up here, kind of at the lows of the session, but still not seeing big declines today. The Dow off about 81 points, about 0.25%. The S&P 500 still very little change. The Nasdaq up almost 1/3%. A lot of what we talked about today, people sort of waiting for the inflation data to come later in the week. As we know, most of the action and excitement today came from the meme stock trade, which I'm sure Jared's going to talk more about. But GameStop just consistently the top trending ticker of the day after Keith Gill, aka Roaring Kitty, tweeted a cryptic drawing earlier in the day of him sort of sitting forward, or someone sitting forward, and then a bunch of videos the rest of the day. AMC off its highs of the session, up only 80% on the day, but it was a fun little flashback to 2021, Jared, wasn't it?
Well, I'd like to think there's more to come, and we'll have to see what happens here. But it was a bit of excitement that, admittedly, I wasn't expecting when I woke up this morning. Now, here's the sector action today. I'll even get to the meme stocks in a minute. I just want to point out that on a day when most of the sectors were in the red, only tech managed to make it to about 0.5%. We saw a lot of fringy behavior, investment behavior in the markets. So let me show you what I mean by that with our leaders. First of all, crypto, Bitcoin up about 4%. Then you have Chinese stocks, which are absolutely battered. Then we have unprofitable tech, that's ARK. Then we have retail. Then solar also hit hard this year. Cannabis really hit hard this year. And so you find all these pockets of strength, which are really on the fringe of the market and not in the core. And when I say that, you can look at techs. Here's software. Even tech was up 0.5%, but it's a mixed board. There's software. Here's semiconductors, a little bit more green than red. And then when you get to unprofitable tech, that's when you see the most green. So a little bit of a head scratcher there. We'll have to see if anything comes of this in the days and weeks to come. Let me just show you the Nasdaq 100 here. This shows a mixed board with respect to the mega caps. And then I did finally promise the meme stocks. Here's let me just sort by performance, go through the final numbers. AMC just short of 80%, GameStop just short of 75%, Tupperware over 40%, Cost over or almost 40%, Newegg 26%. The list goes on. So a lot of these names haven't seen too much activity from in a long time, and then some of them we have. Beyond Meat, for instance, we were writing about a couple weeks ago. We'll just have to see how this falls out.
We'll keep watching. Jared, thank you, my friend. Big move for the market today. It's all about memes. Joining us now with the takeaway of the trading day, Yahoo Finance's very own Josh Schaefer. Joshua.
Should I be leaning forward? Is that what we're doing?
Yeah,
we'll do
well,
that. So we'll start back here.
And then
all right.
Locked in.
We're locked in. We're ready to talk meme stocks, right, guys? Of course, we are talking about the meme that was posted last night, right, by Roaring Kitty, and that's sort of igniting this meme rally that we saw today. I think one of the broader takeaways I had from this was that, if you guys remember, we were talking about meme stocks, I think it was last week or 2 weeks ago.
Yes,
and how
we're starting to bubble up
and like
again.
GameStop had been moving. Right? It was like we looked up one day and it was like, wait, GameStop's up 30% in 3 or 4 days. And it wasn't today, which was pure kind of classic meme stock mania, right? With all the stocks going up. But I did find it sort of interesting to think like, okay, it hasn't necessarily come out of completely nowhere. There's been random interest in this stock for a little bit now over the past month, and really kind of broader in the markets, as I know you guys have been talking about through the hour or two. Like, we've seen people speculating in different areas. Even you just think about sort of the crypto chatter that we've had over the last couple months. And obviously you can't really explain why Bitcoin is going up, but it just has, right? It's your number go up meme, Julie. And so I think we've really sort of had this sentiment maybe bubbling, and this maybe set us off. I don't know how far it goes, of course. No one knows how far it goes. But to me, that was one thing that I was sort of thinking about today. Just like, okay, we've kind of been inching toward this. And it is also important to note that from a broad sense, a lot of market strategists say sentiment has not nearly gotten as frothy as it has in 2021. Right. We've talked about that a lot over the last couple months. We're not in bubble territory. It isn't, no matter what real metric you use, we're not near 2021 from a froth sentiment standpoint. But this is perhaps her first sign that maybe we're getting closer.
Maybe. I don't know.
What did you make of the argument, Josh, that really the meme stock trade, it never went away. It just found different names, different vessels. I mean, how much have we talked about on this show? DJT, Super Micro, Sweet Green.
Oh no, for sure, right? And it just, this brings us back because it is Roaring Kitty and it is sort of that Wall Street bets crowd. It brings us back to the original meme trade. But you're right. I mean, we've been talking about meme stocks on and off since 2021, really, right?
It's or meme stocks by other names, right? Whatever
like,
they may be.
People have labeled Carvana as it in the past, right? And now, I mean, they're having a fundamental turnaround there that you can maybe argue the company is actually doing well, but it's still, there's a short squeeze aspect to stocks like that, right? And that's where the interest really comes from, and that's sort of how you see the shares shoot up. Yes, it feels like we haven't fully lost it. I mean, even Reddit, when it went public 2 months ago, the first short report to come out on it, an analyst was already calling it a meme stock, right? They were saying this has meme-like characteristics to it. It's trading disattached from fundamentals. The stock is way too high. And so that phrase is, I don't know, we use that phrase a lot now. So it does feel like we're always still talking about it, but it hasn't been necessarily GameStop and AMC, so I guess that's kind of the takeaway.
Although they come up intermittent. I love the idea though, like the image in my mind of like the sleeper cells of like all of the like Reddit traders or Wall Street bet traders, and then they were awakened. Like the code word was. So I was
going to ask you, were you surprised like how quickly this all happened?
I
or not surprised because that's just kind of how it works.
Surprised but not shocked. You know what I
Yeah.
mean? Like, this is kind of how this thing works. As we talked about earlier, there's a nice, like, sort of fun aspect to it.
Yeah.
It's fun to talk about. I mean, I do wonder what's going to happen from here. Are we actually going to get more direct communication from Roaring Kitty, or is it, because his bag was always, as we pointed out earlier in the show, him on camera giving the fundamental case for GameStop. Right. This is much more cryptic and sort of, he's posted, you and I were talking earlier, he's been posting all these like movie meme mashups today to try to communicate something to people. So I don't know if we'll actually hear from him directly. That would be fun.
Or are they looking at something else? Like everyone just immediately jumps to GameStop, right? And that's sort of where the target has been today. But there hasn't been a lot of online discourse that there's like a little bit of discourse, but like, remember in 2021, we got to like, what are other stocks that are shorted heavily, right? And that was sort of where like the speculative bubble went next. And I guess when you look at the action today, maybe you did see some of that. A lot of the shorted stocks that Jared was highlighting were up. But like, is that sort of where the discourse goes next?
I don't know.
What is Roaring Kitty even talking about? I think it's something I'm still wondering.
Does he come out and make a fundamental case for another stock entirely? That would be fun.
Tupperware stock.
Maybe.
I want to see him back the fundamentals of Tupperware, Julie.
Yeah, okay.
That's my ask.
Tupperware party at Keith Gill's house. All right, thanks, thanks so much, Josh. All right, let's broaden it back out because markets were mixed at the close with the Dow snapping 8 straight days of gains. But we do have big economic data on deck with the Consumer Price Index out on Wednesday. For more on what to expect, we've got Gus Fauché, Chief Economist at PNC Financial Services Group. Gus, it's good to see you. So we've been talking all about this anticipation for the inflation data. I know that you have been doing a lot of work on this and also work on kind of how the inflation data relates to the job market, how the Fed is viewing that. So put it all together for us. What are you expecting this week?
So we're expecting to see a 0.4% increase in the overall CPI from March to April, and then a 0.3% increase in the core CPI, excluding food and energy. That means we would see year-over-year core inflation slow from 3.8% in March to 3.7% in April. That's good news from the Fed's perspective, but the Fed does want to see inflation move even lower. And so I think we see the Fed on hold in the near term until they get more definitive proof that inflation is really slowing.
And Gus, how confident are you that we get back to the Fed's target in the next 6, 12 months? And what needs to happen, Gus, for us to do that?
I think we need two things for that to happen. The first is that we need to see slower growth in housing costs. So when we look at measured rents, those are falling pretty quickly, but we haven't seen that show up in the shelter component of CPI yet. I think that will happen over the months ahead, and so we'll get some help there. And then I think we need to see a bit weaker wage growth. Wages are growing around 4% year over year. I think to get to 2% inflation, we need to see something closer to 3.5% wage growth. I do think with a bit softer job growth, with perhaps a bit of an increase in the unemployment rate, we will see slower wage growth. And given slower wage growth, given slower growth in shelter costs, I think we'll be back to that 2% objective by this time next year.
So what does that say about the Fed's ability to cut before this time next year?
The Fed doesn't need to see that inflation is at 2% to cut year over year. What they need to see is that inflation is moving toward 2%. Even if the Fed were to cut 1, 2, 3 times, monetary policy would still be contractionary. It would still be weighing on the economy, just not as much as it is now. So I think that if we do see the inflation numbers start to look a little bit better, we see that inflation is indeed slowing, then I think the Fed feels comfortable cutting, I would say sometime, let's say at the September and then again at the December meetings, 25 basis points each time.
So maybe September, Gus. I'm just curious whether you think, does it get tougher for the Fed to cut though as you get closer and closer to the election, Gus?
I think the Fed will take into account the election, but I think if inflation is slowing, I don't think the Fed wants to wait too long. I think they're concerned about waiting too long to cut rates. That could increase the drag from monetary policy. So I think as long as we see better inflation numbers, the Fed will be okay cutting in September, and then they can cut again in December after the election.
Since you mentioned the election, we have to ask, how you think that's going to play into their decision making.
I don't see that as a big factor. I don't think the Fed is going to be cutting rates aggressively heading into the election. I think that would look bad. I also don't think the Fed is going to see any need to raise rates heading into the election. I do think that we'll see slowing inflation, and that will allow for cuts. So I think if the Fed cuts once this year before the election, I don't view that as a big deal. That's not their attempt to influence the election. That's just their attempt to stay on top of things. And I don't expect that that's going to deter them one way or the other.
Gus, switching gears a bit, we do have some big retailers reporting this week. Gus, got Walmart. We also have retail sales. I'm curious, Gus, to get your take on the consumer, how healthy and resilient the consumer looks, Gus, because we do hear this talk of, consumer frugality, consumers trading down. What are you hearing and seeing, Gus?
So we do expect to see a bit softer growth in retail sales in April. We had a very, very good March. So I think, we see retail sales up about 0.4%. If you take out autos, maybe up 0.2%. Some of that is higher gasoline prices. But I think consumer fundamentals are still very, very good. Good job growth, good wage growth, slowing inflation, rising household wealth with higher stock prices and home values. The big drag is coming from higher interest rates. But overall, I think consumers are in solid shape, and they will continue to increase their spending throughout 2024 and into 2025.
Gus, thank you so much for joining the show today.
Thank you.
Coming up, meme stock buzz took center stage in today's trade. We're going to speak to the head moderator of Wall Street Bets. On the other side, more market domination overtime is coming up.
Let's get you up to speed on today's session, or recap it at least, sponsored by Tasty Trade. We had a mixed day here today as folks await the inflation data coming later in the week. As we mentioned, it's wholesale prices tomorrow and then consumer prices coming on Wednesday morning. The Dow down about 1/5 of 1%. The S&P little changed. The Nasdaq down about 1/3 of 1%. Industrials, financials, and consumer staples leading the declines. Tech and real estate getting a little bit of a boost today.
Meme stock buzz taking center stage in today's trade as GameStop shares soar. The move higher coming after Roaring Kitty, the person behind the meme stock frenzy during the pandemic, posted online for the first time since 2021. Joining us now is Noor Al, head moderator of Wall Street Bets. Noor, it is great to have you back on the show. So let's start there, Noor. It was the story of the day today. Roaring Kitty posts on X, GameStop rips. What did you make of it?
I just immediately knew as soon as I saw that tweet that retail trading is back and we're going to see more volatility than ever these next couple days.
So, Noor, that's interesting because we've been sort of debating here, like, was this just a sort of one-off excitement and then it's going to fade? It sounds like you don't think so.
No, absolutely not. I mean, I think we've actually seen the buildup for today's activity over the past 2 weeks. And even just 3 days ago when we were talking about DFE liking a tweet for the first time in 3 years. So there's precedence and there's been a lot of buildup to this moment, to today.
Are you saying, or you think the activity continues in GameStop, or no, it's going to shift to other names?
I think GameStop is definitely going to be the stronghold. That's what we've seen in previous explosions of retail excitement. But that's definitely going to spill out into other stocks. We saw AMC today up almost 80%, even more than GameStop, really. So I think you'll see both. You'll see GameStop explode, and you'll see the others explode in sync with it.
Noor, I'm really curious, as someone who does what you do in terms of, and that's your sort of side thing here, that you moderate Wall Street Bets. What did your day today look like after that came through this morning?
It's chaos. I saw the DFB's tweet yesterday, and I just knew, wow, tomorrow is going to be an intense day. I took the day off, and I've honestly just been looking at Reddit all day, hanging out in Discord and making sure that, you know, the millions of people that are visiting our subreddit, our community, are having a good time, having a good experience.
So, okay, and are people super psyched? Are you seeing an uptick in volume? Are there people who've sort of been on the sidelines for a while who now saw this and came flooding back to the platform and back to the markets?
Absolutely. We're seeing a huge uptick everywhere. So page views are up, uniques are up. We're seeing more people tossing money at the market. We're seeing people post their, we call them YOLOs, and their gains, people taking profits, people throwing all those profits back into the market. Every stock you can name, we've been seeing elevated levels of activity on them today. So I think this is just the beginning, though.
Do you, Noor, though, and we've been talking to different guests about this today too, so I want to get your take. Do you look at what's going on in GME today, and it's some broader tell to you about some serious trend or theme in the market? It's telling you something about risk appetite ramping, or do you see it, Noor, for most people, do you think it's more just fun, it's something to do, it's entertaining?
I think definitely people are having a ton of fun, but it comes down to really just people seeing more opportunity in the market. We know we've been sitting on quite a bull run for these past couple months. SPY is at all-time highs. People want to take some money off the table, realize those gains, and toss them back into riskier plays. I think that's what we're seeing.
Noor, can you tell us, and Josh sort of asked this, but if you can expand a little bit, like, is there buzz around other stocks as well?
Yeah, absolutely. I mean, we're just coming fresh off the AI hype cycle. Now we're going right back into the meme stocks. So I think you're going to see all meme stocks move together. And really, I think this just shifts a broader shift towards, narrative economics. Can companies tell their story in a compelling way and really engage with their shareholder user base? So we'll see both a trend from investor appetite for those kinds of companies and hopefully a shift in companies and how they manage their investor relations.
I mean, the irony of this, though, is that GameStop is not doing that, Noor, at all. They don't talk to anybody, right? They don't have conference calls. If they do have conference calls, they don't ask questions. There's not a lot of transparency around what they do. Why do people still love GameStop?
That's a good question. I think you can look at companies that over-communicate and companies that under-communicate. People believe that GameStop has a plan and is executing on that plan. We're seeing them swing from tremendous losses in previous years to actually a net profit last year. Although it was small, we're seeing their underlying business kind of grow and trend closer towards green. And I think in the absence of their Q&A and answering those hard questions, people are coming up with their own narratives. And so narrative economics doesn't necessarily mean the company has to create the narrative, but that narrative is being created. And that's why it's so important to stay close to the source, close to social media for these stocks.
Yeah, I love that. Narrative economics. Quickly, Nora, I'm curious, given you saying that, are you a believer in the GameStop story and do you have the shares?
Absolutely. You know, today is just day one. We saw plus 80% today. Who knows, or 75% today. Who knows what tomorrow will hold.
Nora, always love having you on the show. Thank you for joining us.
Thank you so much.
Time now for To Watch Tuesday, May 14th. President Biden is quadrupling tariffs on Chinese electric vehicles as early as tomorrow. Total tariff on Chinese EVs is going to rise to 102.5% from 27.5%. This is according to a report from Bloomberg. Biden will also sharply increase levies for other key industries sometime this week.
Moving over to the economy, we will get some key economic data this week, starting with producer prices coming out tomorrow morning. Economists forecast PPI will tick up slightly while core PPI holds steady. This reading will come ahead of April's CPI reading, or Consumer Price Index, on Wednesday.
And after the PPI print, we're getting another round of Fed commentary, this time from Fed Chair Jerome Powell and Fed Governor Lisa Cook. Wall Street will look for clues to see how the latest data affects monetary policy.
And finally, more earnings coming out tomorrow. We've got Home Depot, Alibaba, and On Holding reporting, among others. Home Depot announcing first quarter results before the bell, and analysts expect the company's same-store sales to drop by 2%.
Coming up, the gaming industry hitting a rough patch amid economic uncertainty, elevated inflation. We'll take a deep dive in today's investor playbook on the other side. The gaming industry hitting a rough patch amid economic uncertainty, elevated inflation, concerns of a slump in the video game industry is settling in after Roblox cut its annual bookings outlook. Meanwhile, investors waiting on results from video game companies Take-Two Interactive and Ubisoft this week. Joining us now for the Yahoo Finance Playbook, Wedbush Securities Managing Director Michael Pachter. Michael, it is great to see you. If we're talking video games, we got to talk to Pachter. Let's start big picture, Michael. Video game industry right now, how healthy and strong and resilient does it look, Michael?
It's probably as healthy as it's ever been. I think that we had a lot of games that were canceled and a lot of games that I think the publishers have decided just aren't worth chasing. And what that really means is that tastes have shifted away from buying the $70 game and in favor of playing the free-to-play game. Overall revenues are growing nicely. I mean, growing definitely solid.
Oh, I think, Michael, we're having a little bit of issue with the connection there with Michael Pachter. Michael, you still there?
You are?
Oh, we
Goodness.
were. I think we're
yeah,
gonna.
I hear you clear, loud and clear.
Okay, well let's. Are we gonna keep trying, y'all? Okay, we're gonna keep trying. Michael, what I was just gonna say then, as you talk about the sort of steady revenues from these companies, is they're not trading like they're doing well, right? We've seen most of them see slumps this year. So why the disconnect?
Because I think that the publishers have recognized over the last couple of years that they can't just throw anything out there, that they have to provide really premium content in order to charge a premium price. And they've spent way too many of their resources expanding the brands. So having that holistic approach to FIFA, which is no longer called FIFA, or to Call of Duty, having a couple of free-to-play games to augment the premium game. And so what that means is that the smaller games kind of get left by the wayside, and the gaps being filled by smaller publishers. Consumers still want that stuff. It just doesn't pay off. So think about it like the movie industry. We get more Marvel's Avengers and far fewer romantic comedies. That's what the publishers are starting to reconcile right now, that they need to offer big blockbusters and 360, experiences where you're always playing mobile or free-to-play PC in addition to console.
Michael, and just to follow up on Julie's point, you look at EA and Take-Two, both well in the red so far this year. Are those names you want to buy here, Michael?
Yeah, I like them both. I'd say I probably like Take-Two a little more. We know that Grand Theft Auto is coming. It's already been announced that it's coming. We know it's coming in 2025. Even if the Rockstar guys were to delay it, it'll be late 2025, early 26. And that is a many billions revenue enhancement. And I think the thing I like about it this time around is that Grand Theft Auto Online, which is the free piece of that game, has been built knowing GTA 6 is coming. So they'll incorporate GTA 6 into GTA Online. I think you get a boost to the free-to-play game in front of the release of GTA 6. So I like Take-Two a lot. And unlike EA, Take-Two bought Zynga. They are well along in, kind of diversifying their game offering into mobile. They have a big hit called Match Factory that nobody talks about. I'm about $300 into it already. It's a great game. My wife is in it.
And I'm also curious about Ubisoft, which reports, I think Wednesday it is, after the close of trading. This one doesn't have the sort of franchise like a Grand Theft Auto behind it, but it's one of the bigger studios here. And you guys like that one as well, right?
We do, and for a different reason. I mean, you're right. Their biggest selling game is maybe 12, 15 million units compared to Call of Duty at 35 and Grand Theft Auto at over 100. So, it's a much smaller developer. What we like about it is that they've kind of, their lack of performance the last 5 years suggests that they're positioned to really perform well in the next couple of years. They've got a lot of content backed up and about to launch. So I think you're going to get a big spike in revenue and profitability. And then the other thing is, in that Activision-Microsoft merger, the UK regulators kind of stuck their nose in the middle of all of it, forced Activision to sell the global streaming rights to its content to somebody else, and Ubisoft stepped in and astutely bought up those assets for not very much money. I think they're going to get big checks from Microsoft growing every year for the next several years.
Michael, I also got to get your take on another story today. GameStop, Roaring Kitty, posts on X, the stock surges. What did you make of it?
Yeah, I listened to your guest immediately prior. He's right. Who knows what will happen? There's no fundamental basis for this. And, the story that Ryan Cohen has a super secret plan, and if he tells us what it is, he'll have to kill us. That made sense in the fall of 2020 and throughout 2021 and 2 when he hired all those Amazon executives. They're all gone. Nobody works there with a C-level title except Ryan Cohen, and I'm not even sure he's there. I think that the inmates are in control of the asylum. Your former guest or prior guest said that they're showing solid revenue growth. No, they're not. They're declining by about 10% a year. And as revenues decline, the only thing they can do to keep up is close stores. It's a vicious cycle, not a virtuous cycle. Sure, they made $17 million last year. I'll take the under on that this year. I'd say they have about 5 more years because of their cash position, and then they're a zero. So good luck. Anybody selling today, congratulations. Anybody buying today, my condolences.
You've been consistent on this point, Michael. We appreciate that. Thanks so much for joining us today. It's good to catch up with you.
My pleasure. Thank you.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But we're not done. Stay tuned. We've got the latest episode of Yahoo Finance's video series next. A glimpse at the future of neurotechnology. You don't want to miss that.
Hey, Rodney, I'm Madison. It's really great to meet you.
This is Rodney, and he's living with amyotrophic lateral sclerosis, or ALS, a disease that gradually inhibits all movement, including your ability to communicate. But Rodney has a special technology implanted in his brain. It takes signals from the brain and translates them into commands on an external device, like computer keys. In other words, it reads his mind.
Was it scary to be the first person to get the stentrode? Not really. That's cool. That's pretty brave.
But he's talking to me right now, all the way from Australia, thanks to the stentrode, an AI-powered brain-computer interface developed by Synchron, a neurotech company backed by Jeff Bezos and Bill Gates. This may sound familiar, as Elon Musk is also working on Neuralink. The company introduced the first patient to receive its implant.
It was like using the force on a cursor.
The stentrode and Neuralink are both examples of BCIs that are implanted inside the body. But according to experts, the next big innovation in the space is portable products that live completely outside of the body, like this. This spectrum of devices falls under the umbrella of neurotechnology, which is any technology used to either record signals from the brain and translate them into technical control commands or to manipulate brain activity. Neurotechnology is on the agenda for big tech companies like Meta and Apple. And AI is speeding up advancements in neurotech, which can be empowering for patients, but as the tech becomes less invasive and more accessible for everyday consumers, it could put our most valuable data, our thoughts, at risk.
This is our final fortress of privacy, and we've given up every other aspect of privacy that exists.
After first-of-its-kind neuro rights legislation was passed in Colorado, experts and activists are working to make federal policies about our thought data. This is what's next in neurotechnology and data privacy. Meta is funding a team of neuroscientists who are pushing this field of research even further by using AI to understand how humans process language. The company says the goal is to help people who've suffered traumatic brain injury to communicate.
We did a research where participants watch images in a neuroimaging scanner, and the goal is to train an AI system to reconstruct what they see solely from brain activity. And what's surprising is that it works much better than what we anticipated.
Volunteers sat inside a magnetoencephalography, or MEG machine, which measures the magnetic field generated when neurons fire. Over the course of several hours, volunteers viewed each image for 1.5 seconds, and the AI system learned those MEG recordings. This is the image that was flashed in front of participants, and this is the image that the AI scanner was able to recreate.
And so you can see that the images on the right are never quite accurate, but still it does capture a lot of semantic properties, like when it is an animal, it tends to be an animal. And that suggests that these magnetoencephalography signals, this brain signal that can be captured in the lab, can be used to recreate the image that they perceive. The first reaction was, okay, there is something, we must have leaked some training data in the test sets. That was my first reaction. Okay, let's try to find where we could have had some bugs that could explain the quality of these results.
So you thought they were so good, there must have been a bug?
Yeah.
When I look at these images, they did such a good job. It looks really good. So it makes me wonder, like, is this a mind-reading technology?
So this is not a mind-reading technology at a given instance. What we can try to do is reconstruct the image that they see at the given moment. So we're really decoding perception. What has been shown in other research is that trying to decode what people think at a given instance on their own without being triggered by something is actually much, much harder.
In regards to the relationship with Meta, does that impact the outcome of any of the research?
So the goal of our research is not to have a product down the line. This is a research which fits a portfolio of research projects at Meta. The goal is really to figure out the key principles of intelligence and what makes humans so able at learning things extremely quickly.
His team is part of FAIR, which stands for Fundamental AI Research. Meta has been studying how AI learns language since before the company changed its name. That F in FAIR used to stand for Facebook. But the team is not attached to any medical or academic institution. King stresses that consumer-facing products are not the end goal of his research. At the same time, Meta is continuing to work on consumer neurotech.
I think we'll start getting some consumer neural interfaces soon.
I'm not talking about something that jacks into your brain. I'm talking about something that you wear on your wrist that can basically read neural signals that your brain sends through your nerves to your hand to basically move it in different subtle ways that are maybe not perceptible to people around you. But we're basically able to read those signals and be able to use that to control your glasses or other computing devices. And I think that's going to be pretty wild.
Since 2021, Meta CEO Mark Zuckerberg has touted an armband that sends
these like nervous system signals to your muscles, and you can actually pick those up with an EMG wristband.
EMG measures muscle responses or electrical activity in response to a nerve stimulation of the muscle.
They have a prototype of the wrist device. It's something that they're investing heavily in with Reality Labs. Billions of dollars go towards that. They are making progress in certain areas, whether it's their AR, VR efforts or these kinds of efforts that will eventually feed into what Mark Zuckerberg sees as the future, if not necessarily of the metaverse, then of technology.
In 2022, Apple filed a patent for AirPods that use electroencephalogram, or EEG technology. The proposed earbuds could contain over 24 electrodes that are configured to measure biosignals and electrical activity of a user's brain.
I think in-ear EEG is going to be much richer data than EMG on the wrist for brain health and wellness, which is a huge potential market.
When it comes to the products that are on the marketplace right now, are they over-promising or are they accurately, to a degree, with some noise, reading our minds?
Or are they actually decoding, like your private ruminations, like you're thinking about, what am I going to make for dinner? Those kinds of things aren't being decoded by these today. What they're decoding are basic brain states that can be averaged across the entire brain. So things like, are you sleepy? Are you paying attention? Are you stressed? Basic emotions, are you happy or sad? Those are metrics that can be picked up. And in some ways, that's mind reading, right? It's still revealing things about your inner states, but it's not the kind of robust thoughts, which isn't to say that isn't possible. It is to say that none of the consumer-based EEG devices that are on the marketplace can yet do that.
According to one estimate, the neurotech industry was valued around $15 billion in 2023 and is projected to reach over $55 billion by 2033. This comes as AI has fueled earnings growth for the biggest tech companies. Tech giants like Alphabet, Nvidia, and Amazon have all seen double-digit gains this year following increased AI investment. As AI-powered technology accelerates advancements in both medical and consumer-facing neurotech, one analyst says investors should look at companies that are prioritizing privacy.
If you can monetize that data safely, I mean, that would be a great play for a lot of people. I mean, if you actually provided the right product and service.
I think people just don't understand what it means to live in a world of complete brain transparency. The one space we have for mental reprieve is really, our brains and mental states. It's the kind of final piece of the puzzle.
Dr. Rafael Yuste is a professor of biological sciences and neuroscience at Columbia University. After years of research, he discovered a way to control the thoughts of mice using lasers.
This was actually my Oppenheimer moment, but at the same time, I felt whatever you can do in a mouse today, you could do in a human tomorrow.
He basically did Inception in real life, and it scared him so much that he started the NeuroRights Foundation, which says it works to protect people from the potential misuse or abuse of neurotechnology. The foundation recently evaluated the privacy practices of 30 major consumer neurotech companies, selling a range of devices, including headbands, bracelets, and glasses for activities like sleep, meditation, and gaming. Upon reviewing the consumer user agreements, the foundation determined that
30 out of 30 companies takes possession of all the data of the user.
This is not dissimilar from most privacy agreements that users are familiar with, which allow tech companies to collect your data. The difference is these companies are collecting your neural data, and Dr. Yuste says that could warrant additional privacy protections. The study found that over 66% of neurotech companies' policies mention they can share data with third parties, while 30% of companies are unclear on the matter of data sharing.
That third party could be a company, could be whoever they want. They could be a foreign agent. So from our point of view, this is not okay.
Over half of the companies included don't even mention neural data in their privacy documents, making it unclear whether that data would be protected.
The current regulation of commercial neurotechnology is being treated as consumer electronics.
Take Apple, for example. According to the company's privacy policy, personal data is any data that relates to an identified or identifiable individual, or that is linked or linkable to them by Apple. This includes data like your email address, location, bank details, and search history. Products like the Apple Watch can also collect your health data, like your sleep time, heart rate, and respiratory rate. But at no point in Apple's privacy policy is neural data mentioned. That AirPods patent came after CEO Tim Cook announced the company's focus on healthcare.
I believe if you zoom out into the future and you look back and you ask the question, what was Apple's greatest contribution to mankind? It will be about health.
Health data that can reveal a lot about an individual, but also generate a massive amount of personal information.
When they can correlate all of that information with the in-ear EEG data, suddenly they have a treasure trove of information to not have you just close the circles for how many steps you've taken a day or how physically active you've been, but your stress levels and your cognitive fitness, to really correlate what's happening in our brains with all kinds of neurological disease and wellness kind of metrics.
Neurorights advocates say advancements in neurotech in recent years require urgency in the form of immediate regulation to protect our privacy and brains from being hacked, manipulated, and attacked. The Neurorights Foundation developed a framework for potential neurorights policy focused on mental privacy, personal identity, maintaining free will, protection from bias, and fair access to neurotech for those who want it.
We want to develop neurotechnology. We think it's good for humanity, but we want to do it in a responsible fashion. This is about responsible innovation.
Innovation that could already be helping people, at least according to Synchron.
There's millions of people, almost 8 million people here in the United States alone that have some type of motor impairment, where it becomes real challenge to use devices that we take for granted every day. Like everybody walks with a phone. Technologies like this can really start to aid for those that can't do that.
Even if it's tiring, has the device made communicating easier for you overall? Yes.
I think that's the one thing that people really don't understand, is that this is not like 20 years out. It's not even 10 years out. I think we're in a shorter timeline than that.
For Farahani, the speed of innovation requires quick policy action. Her framework favors a broader approach that argues for more privacy overall, with a right to self-determination over our brain and mental experiences.
That would give people a right to be able to both access and use the technologies if they choose to do so, a right to mental privacy as an explicit part of the right to privacy. And that would mean that we'd have a right against interception and interference with even the automatic processes in our brains, and then a much more robust right to freedom of thought. And I think of thought as like really the mind reading stuff, right? It's like what you're thinking and feeling, and being able to have a right against the interception, the manipulation, and punishment of those thoughts.
Regulators and governments are beginning to take action on this. With the help of Dr. Yuste, in 2021, Chile became the first nation to amend its constitution to protect the right to mental privacy and free will. Mexico and Brazil have also proposed constitutional amendments for neurorights. Domestically, Colorado passed a bill that expanded the state's Privacy Act to include neural rights, the first of its kind in the U.S. Similar legislation is on the table in states like California and Minnesota.
What is your biggest hope for what this industry looks like 10 years from now?
My biggest hope is that it is a tool of empowerment for individuals, that people have really the ability to control their own data, that we have a system of trust and rights that strongly favor individuals and their right to cognitive liberty, and they're able to use the insights to improve their brain and mental experiences, their mental well-being and mental flourishing.
What do you hope the device will accomplish long term? Hopefully it will get to more people.
The United Auto Workers Union is setting its sights on the South again. Mercedes-Benz workers in Alabama began voting today on whether to join the UAW. This coming after a historic victory at a Volkswagen plant in Tennessee just weeks ago. For more, we're bringing in Yahoo Finance's Praz Sumrain. Praz.
Yeah, 5,000 workers down in that plant in Tuscaloosa, Alabama, voting today, starting today, to potentially join the UAW. You mentioned this comes after that big win in Chattanooga, Tennessee with VW. That was I think the third time that they attempted to join the UAW, and this time they pulled through. A 3-1 margin was the actual vote there. So kind of big implications down in the South for the unionization. This kind of place is not friendly to unionized labor, but the tide might be changing. Some workers are complaining down there about working conditions, hours, pay. They're seeing what's happening in Detroit, the benefits that they're getting, the benefits of being part of a union. So I think it's a big vote. If another domino falls here with the Mercedes plant, I think Sean Fain and the UAW can kind of count on maybe potentially more moves down there as time goes on.
Well, we've seen very sort of contentious negotiations between the union and some of the U.S. automakers. What has Mercedes' sort of vibe and attitude been towards this whole effort?
It's been really surprising, actually, because of the fact that they're heavily unionized in Germany. In Alabama, they've been hiring anti-union speakers to come to the plant to speak to them. They're playing videos in the factories about why joining the union is bad news. We're working together. We're a team. We don't need the union. And it's kind of been pretty contentious. In fact, the workers filed a NLRB complaint against Mercedes. And there's been some U.S. government representatives complaining to German representatives in Germany about the kind of actions Mercedes taking in this union sort of labor sort of dispute. So it's pretty high stakes right now. And I think it's kind of Germany's sort of marking the line in the sand. They don't want to necessarily Mercedes to bring unions into that plant.
Very interesting.
Yeah,
Thanks a lot, Pras. We'll be watching the vote closely. Appreciate it. Well, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.